My name is Lucas Rodrigues, and the entity I have chosen to create a presentation about is SoFi Technologies Incorporated. Specifically, I will be discussing an upcoming stock sale to a venture capitalist. First, I will give information about SoFi, what goods or services they provide, and what kind of company they are. I will then explain what a stock sale is. Then I will differentiate a stock sale from an asset sale. Next, I will talk about the SEC and explain why it exists. Lastly, I will move on to describing Rule 144, the conditions that it provides, and I will describe Form 144. SoFi stands for Social Finance. It is a financial technology company that operates an online platform that provides financial services such as personal loans, auto loan refinance, home loans, mortgage loans, and investments. They also provide insurance products. SoFi went public on June 1st of this year following a merger with a special purpose acquisition company, or SPAC. Stocks are a type of security or tradable financial asset that gives stockholders a share of ownership in a company. A stock sale on the stock market occurs when an existing owner of shares goes through a transaction with a buyer. A stock sale is different from an asset sale. During an asset sale, tangible assets, such as pieces of equipment, and/or intangible assets, such as patents belonging to a company, are sold to a potential buyer. The benefits to a stock sale are that you get to invest in a company and have potential upside in the future, and you do not have any liability when it comes to matters such as the company getting sued. The negative side of a stock sale is that you do not get as much of a say in the company's day-to-day decisions. Stockholders do get to participate in votes to determine huge matters, such as if the company wants to go through a merger, but they usually do not get a big say due to the volume of other shareholders. The big pro of an asset sale is that you get to have complete control over whatever you decide to purchase. This means the buyer can have control over how much liability they are going to assume. The con of an asset sale is that the buyer needs to have an understanding of what they are purchasing and what kind of liabilities come attached. In other words, there can be a lot of work that comes with certain asset purchases. This could be in the form of contracts that might need to be negotiated with suppliers, customers, and employees. Now we move on to the Securities and Exchange Commission, also known as the SEC. The SEC exists to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. In other words, the SEC wants to promote a market environment that people can trust. Rule 144 allows public resale of restricted and controlled securities if a number of conditions are met. Restricted securities are securities acquired in unregistered private sales from the issuing company or from an affiliate of the issuer. Controlled securities are those held by an affiliate of the issuing company. An affiliate is a person in a relationship of control with the issuer, such as an executive officer, a director, or a large shareholder. Under federal securities laws, all offers and sales of securities must be registered with the SEC or qualify for some exemption from the registration requirements. This is in order to regulate transactions. The first condition of Rule 144 is you must hold restricted securities for a certain period of time. If the company that issued the securities is a reporting company, then you must hold the securities for at least 6 months. If the issuer of the securities is not subject to the reporting requirements, then you must hold the securities for at least 1 year. The next condition is that there must be adequate current information about the issuing company publicly available before the sale can be made. The third condition is if you are an affiliate, the number of equity securities you may sell during any 3-month period cannot exceed the greater of 1% of the outstanding shares of the same class being sold. Or if the class is listed on a stock exchange, the greater of 1% or the average reported weekly trading volume during the 4 weeks preceding the filing of a notice of sale on Form 144. The next condition provides that if you are an affiliate, the sales must be handled in all respects as routine trading transactions, and brokers may not receive more than a normal commission. Neither the seller nor the broker can solicit orders to buy the securities. The last condition is that if you are an affiliate, you must file a notice with the SEC on Form 144 if the sale involves more than 5,000 shares or the aggregate dollar amount is greater than 50,000 US dollars in any 3-month period. If you require a Form 144 and have met all the necessary conditions, then you will need the following information. The form is pretty straightforward to fill out. You need the name of the issuer along with the IRS identification number, SEC file number, and address. Then you need the name and relationship of the person whose account the securities are to be sold. Now you must fill out information regarding the stock sale, such as the title of the class of securities to be sold, number of shares, market value, and name of security exchange. You also must provide the nature of the payment. This could be cash, a wire transfer, or even cryptocurrency. This concludes my presentation on SoFi Technologies and a stock sale. Thank you for your attention.